All right. Hello, everybody. Welcome back to another episode of The Market Close. We are live. We've got Amazon on deck. We've got Apple on deck, a bunch of other companies. I'm here with Jose and Sam. Neil should be joining us in a bit. It's been quite the day in the stock market in terms of what has been happening. Obviously, the big story, and we will talk about this more tomorrow because we got earnings to focus on. But obviously, I think everyone has seen the news. Leopold Situational Awareness, one of the biggest hedge funds in the world, 45 billion of assets in the context of riding the AI wave, has been liquidated. And the buyer of those assets was Citadel. Absolutely crazy stuff that's going on. We'll have a lot more to talk about it. But that is the backdrop going into these earnings. Massive rally in the semiconductor names because essentially the market is interpreting that Leopold liquidation as the bottom. The structural deleveraging hopefully is done. And now we've got Amazon and Apple. Jose, Sam, what are you guys expecting?
I just hope Amazon doesn't break it. That's it. That's all I want. Amazon, you have one job.
Jose, your mic is hit. It's not just me, right?
No, it's not.
It's not just me, right? Okay.
Yeah.
I think just unplug it and come back in. Sam,
yeah.
You've held Amazon for a long time. How are you feeling?
Yeah, I mean, it's been a freaking wild ride. Amazon's like up and down the portfolio. Meanwhile, everything is like just down, right? So I was just telling you guys beforehand, I was like, dude, I was looking up last night. I'm like, man, I got butchered, solid bounce. I'm like, okay, maybe we're still back in this game. So I was awake when I saw that news last night about Leopold, and I didn't really.
So was I. It was like 11:30 at night.
Yeah. I didn't think much of it because they're referring it to SALP, and I don't know. I've never seen that term before. And then I was like, wait a minute, what? And then I was reading the stuff as it was coming out this morning after I woke up, and I was like, no freaking way, maybe. But the Microsoft earnings yesterday were pretty wild. I was expecting a CapEx raise. I think just flat CapEx did the job for them because that means they're not going to go free cash flow negative. For Amazon today, we don't want to see them go free cash flow negative. They go free cash flow negative, that might be pretty bad. I think they're probably still going to raise CapEx, being that the largest hyperscaler in the whole world. But I do think that the AWS growth has to be marginally better. Not marginally, way better than marginally better.
So do you know? And this is the point of conversation for Amazon. Do you know the street expectation for AWS growth?
I don't know the street expectation. It's got to be.
So like the street expectation is 32%. The Whisper numbers are 36%. For those that are not familiar with Whisper numbers, it's what the actual expectations are. And then the exit numbers, which are like a layer above the Whisper numbers, are 40%. So it doesn't mean that AWS has to hit 40% growth, but if we're looking for like a sizable pop, especially if the CapEx grows and they don't kind of mediate like Microsoft, it's got to be above 32 at minimum. And the question is, do you think they have enough backlog to actually grow AWS at that scale now?
Saying Anthropic scale up very quickly. A lot of their computers through Anthropic. They don't have as much OpenAI exposure, and Microsoft did make it a point to say in their earnings call many times that a lot of growth, 90% of the growth is outside of non-frontier companies, right? So the fact that they said that, I think it's good news for AWS. 40% plus, I would be wild if that was the case. Like the market's gonna be flying if that happens. I think the market has expected their CapEx to be higher. I don't think that they're going to come in and say the flat. If they say flat CapEx, dude, we might get the most face-ripping rally ever. But yeah, I do want to see better margins. I don't want to see the margins get hit. Margins get hit, that might be pretty bad.
I agree. It's definitely going to be something that we need to see. I just put the which one outperforms poll in the chat, Amazon or Apple. So you can put in the chat which one you think outperforms. Triple V, thank you for the $200 super chat. Deeply appreciated. I was talking to our friend Triple V today. He has had an Amazon position for a very long time. So this is one of those stocks that I think a lot of retail owns. And for some people in retail, like yourself or the Chris Camillos of the world that have been pounding the table, it's a massively large position. For some people, levered position. But for other people, I think a decent chunk of people, I mean, put in the chat if you own Amazon, a decent chunk of people have a bit of Amazon. So it's one of those earnings that really matters. And the thing is, the stock has been stuck for the better part of 2 years now, which is why I think people are expecting we could get that breakout. Jose, you're back. Your expectations for Amazon?
hopefully I'm doing much better. Is my mic working? Not working?
Yeah, you're good.
Yes. So, I mean, just expecting massive cloud growth, right? And I do expect to hear more about CapEx growth as well. Just because they are not slowing down. They're making, I mean, the Trainium is getting strong receptions. They kind of announced that they were planning on selling Trainium in the past few months. So we're seeing Anthropic also do extremely well. So I'm pretty excited about their cloud growth. And this is the giant. So hopefully they just don't break the semiconductor market.
Jose, do you think that they're going to actually slow down CapEx or mediate like Microsoft, or no?
No, I think they know they're going to go free cash flow negative, so they can't even do kind of like something that Microsoft said. The market already knows it. I think they're just going to go full on. They're going to send it.
Okay. On top of that, we have Rivian, Reddit, MicroStrategy, Tempest, Big Bear, Roblox, First Solar, Coinbase, Amazon, Apple. So we will try to get to all of those earnings, but obviously Amazon will be the priority. Apple's actually at 4:30, guys. So we'll have a good 30 minutes before we have to deal with Apple, but Amazon and the rest of those are going to be important. Neil, as you are fully aware, thanks for being here. Your expectations for Amazon today?
I mean, like Sam said before, I think you went live. Thank God for today's green market, because otherwise, I wonder how many people would be here. But I mean, AWS growth, what did you say the whisper number was? 36?
36, correct.
So 36 whisper, 33 expectations. So the thing is, it's been accelerating for a couple of quarters in a row. Last quarter, it was 28.4. But we are lapping now two super, well, no, we just lapped one, but the second one is also a very easy quarter, year-over-year comparison. So I wouldn't be surprised if we see 36 or higher. Demand is definitely there. Amazon's CapEx number, of course, does also include all of the logistics, business, network, etc., etc. So we have to take that into consideration. Like Jose said, I do want to hear a bit more about their chips business, which I think they'll share with us. I would say I would be surprised if there is any free cash flow for Amazon, because I mean, I think it's been negative for a while. So
yeah, it has been. Yep.
So,
we got 6 minutes until we get into the print. Just now, getting the notification, Michael Burry has shorted more Micron, NVIDIA, QQQ, and SOXX semiconductor ETF. So the relief rally is being rebuked by Michael Burry. I'll let anyone take the answer to this question right here. Do you actually feel good, and the chat as well, do you actually feel good about today's rally? And not just like, oh, things are up, I feel good, but do you actually feel like it's over? Or do you feel Leopold's not actually the reason we've sold off? That's like one big part, but there's a lot more shit under the surface, and the selling and the sentiment of what's going on with the semi-trade might not be done. Or
I think it has more to do with Squid Game happening in South Korea than it has to do with Leopold getting really... I mean, this story is really a mafia move from Citadel, but I think it has way more to... the Korean, like KOSPI, it's an index, and that thing is down over 30% in a month or so. It's insane. It's not a stock. It's like the whole thing is... That's just crazy. Do I feel great today? I feel better today than tomorrow. Yeah. Do I think it's over? I don't know. Well, I guess we'll have to wait and see. But all of these companies are, 34% over the past month. This is incredible.
Sam, I'm curious.
22% on the year too.
Sam, you think today's a dead cat bounce or no?
I mean, I see oil falling. That's good. I see TLT is flat, so rates aren't going down. You know, actually, the press yesterday was pretty interesting. Usually, you get the next day after a FOMC presser, basically take back what it lost or the opposite direction. We've seen that happen a lot, but the market is slowly pricing out rate hikes this year. I think it's at 66% right now. It was like 78% yesterday for a rate hike this year. I was very surprised to see the odds that close going into the FOMC. But, dude, kind of sus that Citadel is just like, we're going to get a rate hike. We didn't get a rate hike. And then they turn around and buy the dip by buying all the stuff from Leopold or Leofold or whatever these nicknames are that I'm seeing in the chat. I'm very surprised. But, at the same time, I'm going to take it day by day. I'm not going to go all in over here, but it is nice to see a lot of moving averages recovering today. Technical perspective, still not doing too great in the markets right now, but SPYs definitely look a lot better today.
Jose, your thoughts on the strength of this recovery?
I think it's just bullish that it sucks to say, but a lot of leverage has left. I think yesterday there were reports, and again, unfortunately, it sucks to say that, but kind of like in the Korean markets, a nice amount of accounts got liquidated in the past few weeks, all mainly because they were leveraged, right? And then you kind of hear the story today. So there's probably so many stories like that, and kind of getting some of that leverage out, I think can reduce a lot of the volatility in the market for now, until the next leverage cycle begins. But I think for now, it's good to see some of these bounces. Obviously, we can get some pullback, but I'm super excited. I'm really, really happy we had a crazy green day today.
TSM up 8, AMD up 13, NVIDIA up 3, Microsoft up 15 on a $3 trillion company. That's a big move. SanDisk up 25. Software didn't do the best today, but a little recovery from the open. Bloom, that's up 26. Intel's up 11. All these names that were down, many of them 60% peak to trough yesterday, which was kind of the sort of climactic, hopefully end to a lot of that pain. But, it just felt egregious yesterday. They're getting massive rebounds here today. And the question now becomes, what does Amazon say to help impact them? Because theoretically, if Amazon increases CapEx, even if that's bad for Amazon, that should be good for all the names that are up today, because they're going to benefit from that. If Amazon doesn't increase CapEx, do all those names kind of just move around that and not care too much? Or do they actually go red? There's a lot of nuances to it, but Google increased CapEx. Market didn't care too much, even though it took Google down. Meta increased CapEx. Meta ended up getting hit. Microsoft rationalized, and Microsoft got the love. So I think today we're going to hear from the fourth Mag 7 here on, how they're thinking ultimately of CapEx. We got 2 minutes. We'll obviously talk about Apple, Reddit, MicroStrategy. We got all those companies. We'll try to get through Amazon first and then get those results out of the way. I think the Amazon call is at 5, so we'll be listening to the Amazon call. If it's at 5:30, we might start the Apple call a little bit before that, but we will definitely listen to the Amazon call. Pump or dump? Neil, Amazon, pump or dump? What do you think?
Pump, like 3-4%. I don't know if you can call it a pump, but it's up.
Sam?
I think Amazon pumps. I'm not sure about Apple because it's been on a massive run lately. I think Apple dumps, but I hope no one's doing bets based on whatever guesses that I'm putting out there.
Okay, Jose, pump or dump on Amazon? What do you think?
Amazon $252.38 at tomorrow's open.
If that happens,
Market.
If that happens, that's
Reddit up 15%, I say, if we're doing predictions here.
Okay, here we go. We got a big couple of earnings here. Thank you, everybody, for being here Thursday, July 30th. The stock market is now closed. And now we wait. Amazon closed the day, 3.9%. S&P 500, pretty nice rebound, 1.68% on the day. Meta, it was down worse, was at 520, now at 539, but still down 8% on the day. AMD was looking like it could potentially have gone below 400 yesterday, 485. That's up 13. NVIDIA ends at 195. Microsoft, best day it's had since 2020, up 15%. SanDisk up 25%. GE Vernova up 9. T1 Energy up 14. You had UPS that was up a little bit on the day after going down 5% yesterday. Elf was up 1%. SMCI was up 8%. Marvell was up 12%. Dell was up 9%. BMNR up a little bit. Bitcoin had some love today. So overall, a lot of the high beta experienced some of the green. SpaceX actually got $1 billion contract yesterday. And, the stock was basically flat today. So,
wait, what are your predictions? Are we dumping, pumping?
Well, now that it's up 4%, I think I could say it's pumping. I have no idea, dude. I have no idea. But we are getting a little bit of love. 4%. I don't have the numbers yet. 245 after hours. AWS. Okay, I'm gonna read the numbers as I get them. The street wanted 40 billion. They came in at 42.2 billion for AWS. That's a beat on AWS. I don't know what the year-over-year growth is on that, but I'll find out in a second. Operating margins, wow, 13.7 versus 12. That's getting pretty damn close to the 15% operating margins range, which is where they need to get to. So that's a big increase on operating margins. Net sales, 200.6 versus 197. That's a $3 billion beat, similar to Microsoft. Operating income, 27.4 versus 23.6 billion. That's almost a $3.5 billion beat on operating income, likely because of those margins. So their profitability continues to be strong. 250 after hours. EPS 575 versus 182. That's probably a bit skewed due to their Anthropic stake, but still a very nice beat on EPS. As the stock goes up 7% after hours.
Well, I guess
Is it 252 yet?
Yeah. right there. I just saw it.
No, these are great numbers.
Number.
These are great numbers. I mean, like, forget the EPS beat that has a lot of the Anthropic stuff in it. I mean, the operating margins, dude, operating margins for Amazon was 5% a year ago.
Wow.
It's at 13.7 right now. Like, this is kind of the whole thesis. They do a ton of revenue. A lot of it doesn't come down to the bottom line. If they increase their margins with robotics, automation, all that stuff, organic AWS growth, it's going to start hitting EPS, which is going to make the stock look relatively cheap as they continue to grow.
So AWS increased 36.6%.
Wow, they beat the Whispers. They beat the Whispers. So the street had 32%. The Whisper numbers were 36. If they came in at 36.6, they officially beat the expectations and the secret.
What was their AWS growth?
36.6.
I thought it was 43. My bad. Shoot.
Because they did 42.2 billion this quarter, you said, and same quarter last year was 30.8.
Yeah, I mean, this is not bad. Nebius is up after hours. Spy's up after hours. CoreWeave's up after hours. AMD's up. NVIDIA's up. I mean, you had the best day in the past month to report on earnings, and Amazon with these numbers is definitely capitalizing on it. 256 to 250, so a little bit of a red candle, but still up 6% right here. After hours. A couple of the results, and then we'll get into the deeper numbers. Rivian, they beat by 19% on EPS, negative 63 versus negative 78. EPS up 35% year over year. Revenues up 27% year over year, 1.65 versus 1.57 billion. Rivian beat revenue by 6%. The stock is basically flat. Tempest, they beat by 73% on EPS, negative 4 versus negative 15. Revenue 382 versus 379, beat by 1%. Tempest right there is up 1.72. I don't have the Reddit numbers, but if Reddit is up, Reddit's up about 1%, then we should be getting it soon. Rivian did 12,613 vehicles versus 12,145, which is what the street expected. First Solar, they beat by 40% on EPS, 392 versus 281. They missed on revenue by about 10 million. That stock up 4% as well. Revenue's down 4% year over year. EPS is up 23% year over year. A little bit deeper into Mr. Amazon. So they did miss on the guide for Q3. Street wanted 203. They came in at 202. Operating income, they guided for 26.5, which is way better than last year's 17.4. Fastest growth on AWS in 18 quarters for AWS, $25 billion annual run rate for their custom chips. I'm assuming Jassy is going to talk a lot about Trainium and what's going on there. Amazon still up 6%. Free cash flow did come in negative. Wow. Negative 7.6 billion. The street thought it would be negative 3.8 billion. So definitely a business that is not free cash flow positive anymore. But the fact that it's up 6% in the midst of losing that much cash versus the expectations, it just proves that the street is okay with it because AWS is growing like crazy. Up 6% right here after hours. Neil, your raw reaction. to AWS?
I said it before. I said it. Well, I'm not surprised because again, the year-over-year comparisons are easier. It gets harder from here on out. The numbers will get a bit. The year-over-year comparisons are a bit more tricky, but yeah, it's one of the best businesses ever. But by the way, on the free cash flow side, consensus, like you said, was what, close to 3 billion, right?
Yeah.
But the range is between negative 20.9 billion and $40 billion. That's the range.
Oh my goodness.
Of the estimates. So analysts have no idea. So that consensus number is basically worthless. But Amazon as a business, if you look at free cash flow, has always fluctuated. There was always a short period of time where suddenly free cash flow, trailing 12 months free cash flow was through the roof. And then they said, actually, we're making too much money. Let's reinvest it all. And then free cash flow went back down. It's one of the only big companies that our free cash flow margin has been single digits for many, many years.
Okay, we got Reddit and Roblox. Roblox is down 10%. Reddit goes down. Wow, Reddit just pumped to 190 and now it's at 174.
That thing's gonna move. That thing makes wild moves after hours.
That might come right back. Yeah, I agree.
Yeah.
Reddit beat by 30% on EPS, 125 versus 96 cents. Revenue 804 versus 731. They beat by 10%. EPS is up 178% year over year. Revenue is up 61% year over year. I do own Reddit. I don't know if any of you three own this one.
Yes.
You own it? Yeah, this, to me, once again, this company just continues to beat expectations when it comes to growth every quarter. And it got a pump for a millisecond here. Now it's dumping. Something they said is definitely getting the street upset. But EPS and revenue growth are huge. Daily active unique users are also up 18% year over year to 130 million per day. Roblox missed on revenue by 8%, 1.47 versus 1.6 billion. EPS, they beat by 156%. I think this was their first GAAP profitable quarter, 21 cents versus 37 cents. But their DAUs missed by 5 million, 123 versus 128. And it looks like that DAU miss is taking them down 11%. Reddit now down 4%. Rivian's up 1, Nebius is up 2.7, and then Amazon still holding on to 6. Let's get a little bit more coverage on Amazon here.
Was about $200 billion for the quarter. Net sales up 20%. That was stronger than expected. The reported EPS number, we are not going to compare. It was $5.75. There is an impact here from some of the paper gains from Amazon's stake in Anthropic. So no comparable number there. And then on the AWS growth rate, 37% for the quarter. The number to beat, the analyst estimate was 31%. So stronger than expected there. AWS revenue overall also beat $42 billion there in North America revenue. That is the e-commerce business for you. Stronger than expected in the quarter, $116 billion in revenue for that segment. Also a quote from CEO Andy Jassy. He says AWS is booming, in his words. Talked about that year-over-year growth. Called it the fastest growth for AWS in 18 quarters. Also calling out advertising with another strong quarter. That was up 26% year over year. You can see the stock reacting up more than 6% on that news, Mel and Mike.
All right, Kate, thank you. Let's dig deeper into Amazon's.
Jose, your thoughts on these Amazon numbers?
Yeah, I mean, cloud growth was great. Like you mentioned, $25 billion on their chip business. This is something on the annual run rate, growing triple digits percentage year over year. And then they also said 25 billion annual revenue run rate for their AI business, also growing triple digits percentage year over year. So they're showcasing that with their own chips and obviously with everything else that they buy, they're able to make money. I think it was also even crazy that in the letter they said that AWS is booming. I'm surprised they didn't put rocket ships emojis as well on the press release, but that's overall exciting. I do see a lot of NeoCloud players up about 2-3%. I'm trying to see if there was anything in there that is creating, or is it just more of just AI announcement?
Do you think the cloud computing revenue growth is enough to get the NeoClouds to pump on that?
Yeah, I mean, if we hear, especially in the call, hey, we're still compute constrained. Hopefully we get something similar to Google, where it's like we need to bridge something by getting some more third-party data. I think that would be very bullish for a lot of these NeoCloud players.
Sam, your thoughts?
So I'm picking up some numbers over here. Their Q3 guidance apparently missed, but
Yep.
I don't think
Yep.
anyone really cares too much about the e-commerce business, at least not right now. AWS did beat on the top line, which is really good. We already said 37% year over year. I mean, that operating margin is just wild because that beat estimates by 6%. I mean, it still looks good. I actually, you guys are right. I didn't know that they're free cash flow negative already. I must have missed that when I was looking at the numbers last week. But market has already digested that. I think we're going to see what's going to happen on the earnings call. SanDisk is up above 1,300 again.
I
after
think
hours.
I think the memory names love
Yeah,
what
they
Amazon
do.
reported, but we don't
Yeah.
have CapEx numbers yet, right?
They put that in the earnings call, but I mean, why wouldn't you expect it to go up? I would expect
Right.
it to go up. Maybe not crazily, but Google went up by 15%, Meta by 15%, Microsoft flat. I have to be honest, if they say CapEx is flat year over year, I think that would be really good for the markets. But I think we really saw the numbers that we were supposed to see. So, again, I don't know exactly how the market's going to react after we hear those CapEx numbers, but that will be on the earnings call. And I believe they do get, I'm surprised they gave the guidance on here. Don't they usually give the guidance in the earnings call for Amazon?
Usually, yeah.
Yeah.
They usually give only revenue guidance in the
Uh-huh.
press release and then all the rest in the
Okay.
call.
Okay.
Yeah.
I do think that the AI business at $25 billion is pretty wild. That's probably still growing in triple digits. This is a new business that they just started like a few years ago, like already a $25 billion run rate. Pretty wild. And again, AWS is not a small company. So 37% year over year is massive. Like it's certainly no GCP, but GCP it's catching up. 82% year over year for GCP is wild, but those were easier comps. Amazon already had the hard comps, and then they accelerated from 18% all the way to 37%, right? So I think we're starting to see a little bit of the ROI here for these hyperscalers. We need to see that ROI trickle down to cloud. And yeah, Austin said it, 26% year over year for advertising. Advertising has very high margins as well as that business scales. So we're probably gonna hear some commentary on that one. So overall, no wonder Amazon's total operating margin for its whole business or aggregate operating margins is at 13% versus the 12% expected.
Coinbase-
I'm curious to see. Go ahead. Yeah.
Just real quick, Coinbase, they missed by 224% on EPS, negative $1.36 versus negative 42 cents. I don't know how it's that big of a miss, but it might have something to do with their crypto holdings. Revenue 1.2 versus 1.28 billion. They missed by 5% on that. Revenue's down 20% year over year. EPS is down 126% year over year. I mean, these numbers just don't look that good. And it's looking like the market is not happy with the trading volumes right here. Go ahead, Jose.
Yeah. Oh, go ahead. Sorry.
I was going to say, if you can pull up the charts, because I know for Amazon, Marvell and Astera Labs and Credo are big kind of suppliers of them. So I wanted to see if there was any correlation happening on those three players.
Yeah, Credo's up, Marvell is up, and then A-Lab. That pretty much all the semis, including the memories,
Yeah.
neoclouds, are up after hours. Mr. Future Investing, Tanner, your reaction to Amazon?
Amazon's looking great. Reddit's looking great. It was it's been a good day. I've been a little bit out of it today, so I came to listen. I'm not streaming this or anything. I'm just popping in, but celebrating another Mag 7 win with the boys.
Dude, Reddit's down.
Yeah, but dude, I'm not worried about the stock.
Okay.
Blew past expectations. That's what I'm worried about. Long term, they beat by expectations on 10% on the upside, and even more. Like, they have consistently beat Wall Street expectations by double digits. It's mind blowing how good that company is doing.
So
Yeah,
how
it's a
do you
great company.
explain the drop? Is it purely because the market was waiting for maybe a comment on data licensing deals or something like that? Or it's just EPS miss and that's it?
I mean, that could be a very real reason. I need to go through and listen to the call whenever it happens. But in no way do I see these top and bottom lines and then want to sell out of my position. This is a wild company growing at high double digits, 60+% growth rates. Gross margins remain above 90%. EPS is up 180% year over year. Net income more than double. Like, this is wild how good of a company Reddit has been. whenever you compare their average revenue per user versus Meta, they still have a long way to go increasing, how much they're charging per ad, let alone how fast their actual user base is growing. Now, some people have a problem with Reddit, but anyway, yeah.
Big Bear AI in line on EPS, 5 cents versus 5 cents expected, negative 36.7 versus 36.3 million. Revenue's up 13% year over year. EPS is up 93% year over year. The stock is down 4% after being up 9% today. This is one of the smaller cap software AI plays. So the street not fully loving these results. Amazon, baby, almost 10% after hours. I mean, it was a great day for them to report, but also, no, here's the thing. They didn't give the CapEx number. So on the call, if Jassy ends up increasing it dramatically, I mean, we could definitely see that flip and go red pretty quickly. We saw this happen over the past few weeks with some of these other names. I would hope that doesn't happen, but I mean, at least as of now, Microsoft did the opposite. Microsoft tempered the CapEx yesterday and it pumped 10%. So I think that's the question.
Yeah.
I mean, the message yesterday was a interesting one, right? With Microsoft, it's like next year we're still expecting CapEx to increase, but we're also expecting free cash flow to remain positive for the whole year. And then they added, like Sam said before, like 90% of that huge backlog is from non-frontier models. And I think it does help in this situation where the market still believes, oh, what if OpenAI blows up and doesn't reach its full potential, blah, blah, blah. What happens with all of the commitments? So if Amazon can say the same thing, that the majority of its AWS usage comes from non-frontier models, I think it could be good.
But you know what I find so funny about that is I'm going to guess a lot of these people that are going to be these customers are just a different business, but they're also still using the frontier models. It's not like it's a whole different AI company. It's just like a company that's going to be using either OpenAI or Anthropic's models, and is paying for that. So it still kind of goes back to the Anthropic and frontier players.
I mean, plus mix that with OpenAI's announcement from a couple of hours ago, right? Reducing prices quite drastically. I mean, I guess we're getting into a stage where every model needs to reduce its pricing because people want to be way more efficient. Well, let's see if Anthropic will give us that message, or your usage has increased by another 50% because our competitors have made moves and we have to make the same moves now.
I think this is actually good news because cutting those prices means that compute is likely cheaper. I doubt it's because of a competitive reaction to Kimi K3. But if they're able to figure out how to make their models more efficient, that means that compute's going to become cheaper, or as a result, tokens becoming cheaper. I mean, ultimately, Jevons paradox, people are going to use it more now that it's cheaper, right? That doesn't mean that price is going to come down. That would just mean that total revenue is going to come down necessarily. But if you really think about this, this could actually explain the reason why some of the hyperscalers, or specifically Microsoft, made CapEx flat. Because then now they're thinking maybe we don't have to invest that much, but at the same time, they're seeing higher ROI in there and higher margins. So
hold on, Sam, how do you explain Google going negative free cash flow, increasing CapEx, going down 10% on earnings, Amazon going up 10%? It's the same situation. Like, why is the market selling Amazon selling Google?
I think that was amplified based on the day that they report, or the day after they report earnings. Like the whole market was freaking down, and then you had a lot of deleveraging happening. But the
Google is just back to break even. Then Amazon's actually up, right? So theoretically, Google should be at like 350-ish if it was. Yeah,
I mean, that is true. I think I don't know. I can't really explain how the market's reacting, but looking at this though, we did see the margin expansion. Google, of course, did have the margin expansion, but obviously this thing is a completely different story now that we already had a lot of uncertainty out the window, right? So kind of helps having the Fed after. However, at the same time, I do have to think that this Reddit move is probably going to reverse. Like, there's just no way a company can print that kind of stuff and just be down that much unless it was something seriously bad.
Never say never, because 3 months ago, I remember with Tanner, it was very much green and then it was very much red.
So it'll be the other way around. No, I know. I remember he was like they reported the same day as Amazon last time. We were all here. But this is like what? Yeah, go ahead. Sorry.
8 quarters of 60+% growth.
It's crazy.
Okay, it was wildly expensive before, to be fair, but I'm fine with investing in companies that surpass my expectations If my expectations are why I bought it and then they end up beating those numbers, it's a pretty easy hold.
Yeah, I mean, on Memorial Day, Reddit was 142, Shopify was 103, and it seemed like the SaaS apocalypse, had run its course. Now, it's not like it's made a massive move since then, and the fact that it's down another 10% after hours proves how much it's been stuck in a range, but the growth is there. I mean, Reddit got to 127, I think, at one point in like April.
I think I forget who said it, but addressing what's happening with the data sales is going to be an extremely important point. And if they haven't done that this quarter, it might stay sold off until they get that agreement.
Right. Meta's up a little bit after hours. That's making a move. We have Apple in 8 minutes, folks. What do we think on Apple? Do we get a pump or dump on Mr. Apple? I think it's going to be one of their fastest growing quarters in 5 years, which the last quarter was. So I think they're going to sequentially continue the momentum. And if there's any upside to the operating leverage, which I think is really the story on Amazon, and that's probably the reason why it's up more than Google. I mean, Google already has good margins. Amazon has never had good margins. Now Amazon's approaching 15% operating margins. Like, that's a new element to the story that the street's happy about. Maybe Apple starts to increase their operating cash flows as well. But then again, Apple's up a lot already. So I think that's the nuance there. Neil, any thoughts on Apple?
No thoughts on Apple. It's a very profitable business that isn't growing that fast, and yet it gets 30 plus PE like it's nothing. But I guess they don't have $200 billion in capex, so it makes sense. But yeah, I don't even know if it's going to be such a good quarter for them, if I'm being honest.
Why is that?
Why would it be? Like, how? Like, was there a new iPhone? Was there something new that blew up that should push this quarter?
The Mac Mini.
The Mac. Yeah, but the Mac Mini 3 months ago could have also been a huge story, and yet it didn't really change that much. And services is still doing very well for them, but iPhone sales, I don't know what's going on in China, but I don't know. It's priced for perfection, I would say, this quarter, and it's not like it's growing 20%. I think it's still single digits. So,
do you think that the price increases has slowed down people's purchases, or do you think consumers are just going to show up and pay the higher prices that they're asking for?
I don't know how many people that buy iPhones buy the iPhone straight and not through a telecom company or something like that. So I don't know. But the MacBook Neo might be a very good tailwind for them because that's been very successful.
Yeah, everything I'm seeing in the data on the consumer is that the consumer keeps spending. So I would imagine they would keep spending on consumer electronics. By the way, MicroStrategy, they missed by 900% on EPS. They missed by 2% on revenue. Every time this company reports, I'm just not sure why people care. This is a stock that's levered towards Bitcoin. Their earnings literally have zero relevance. So I don't think there's anything to analyze there. If Bitcoin was up, MicroStrategy's up. If it's down, it's down. So that's what you have on MSTR.
I gotta be honest. When Strategy gets liquidated, that might be the bottom of Bitcoin. But I don't know if that's happening anytime soon. Like, these fools just keep buying this stuff. They will raise cash. They're just never gonna get liquidated.
Dude, the fact that Leopold couldn't survive long enough and Saylor's out here just every week finding a way to pump more money into the company, it's wild. It is
while he keeps selling Bitcoin, right? Because he sells Bitcoin, but MicroStrategy buys it, or how does it work?
That's a good question. I'm not sure. I don't think anyone could really explain it, to be honest. Reddit.
That was, by the way, I wasn't even around whenever that Leopold thing, I couldn't stream today, but oh my gosh. And I called that too. I said Leopold was going to be a flash in the pan, and boy, oh boy, did that turn out to be true.
But in the chat, how many people thought Leopold was going to be, and by the way, I the guy's still filthy rich. His fund still made a lot of money. It's just obviously, this was an unfortunate thing, but and he got the stock picks right. He just got greedy with the leverage. But how many people thought like Tanner thought that this was going to happen? I said on Monday, I said on Monday, I feel like there's something happening in the background. There's something with the fund. I did not think it was Leopold. I thought it was some other fund that was stupid and went all in on SanDisk at 2,300 with a few billion. I could not think it was the guy who called this entire revolution ending up getting way too greedy at the top and getting over leveraged.
And it's so funny because it literally felt like Binance pulling the rug out from FTX. It felt so much like that, and yet Leopold worked at FTX. Like, he recreated his old mentors. It's wild. Citadel was Binance in that situation, just big dogged them. So funny.
Yeah, so they sold all their public holdings. They still own $5 billion in Anthropic. And he also said in Financial Times yesterday that he thinks it's an opportunity for Anthropic for the second half of the year. So could have been in, I mean, he obviously made bad, like 4 times leverage is crazy. Reminds me of that guy on Twitter that everyone knows in the path and all that stuff, you know, going super levered up, belly up. Not a hit to that guy, but even you have a smart OpenAI ex-researcher make the same mistake. Leverage is a killer if you don't know what you're doing. And I don't think he knew what he was doing.
Well, that's the thing. He got all the stock picks right. So people thought he definitely knew what he was doing. But then when it came to the internal dynamics of like leverage, knowing that Bloom Energy is a good company doesn't have anything to do with being over levered on it.
Also, he started with 200 million or something, I don't know, and a lot of insider information, because let's face it, that's usually how it goes. Like, why do you need 4x? Like, how greedy can one be? Like, or stupid? I don't know. Maybe both. Maybe
4 times.
Maybe both.
Yeah. Like, I find anytime that you don't hear about these fund managers and then in 1 year they become the biggest story, those guys don't last very long. And it's because they took on a ton of risk, and you have to be extremely well timed and extremely smart to be able to know the right time to deleverage and get out of some of those positions. Because although, you know, he might have been directionally correct in a lot of the names, like I believe in a lot of the Leopold picks, but it doesn't mean that it's going to be going in a linear direction. So be careful with leverage.
Nebius is loving the after hours move on Amazon. CoreWeave is loving it. Marvell loves it. Credo. I mean, this is just like Christmas for the semis after hours because of Amazon. I mean, today was a good day, but the fact that they're moving 4 to 5% after hours, as long as the call goes well for Amazon, and Reddit's also a software name. We got to remember that. So if the semis are pumping, honestly, that could be part of the reason Reddit's dumping. If the semis are going up even higher after hours, you need a software culprit to take down on the other side. Maybe that's also why Reddit's getting hit. SK Hynix is up 1%. By the way, there's a board member who just bought $3 million worth of SK Hynix yesterday. So you got some insider buys. Iren's up 5%. SoFi had a nice recovery today, up 8% after being down 10% yesterday. And then there's Apple. We got 1 minute. What do you guys think? Pump or dump? Tanner, on Apple. What do you think?
Pump.
Neil.
Small drop.
Sam?
I don't think it. Yeah, I agree with Neil. I think it goes down, but I don't think it's going to be down like 5%. Like, liquidity needs to come from somewhere.
Okay, Jose.
$327.
Okay.
All right, here we go. 5 seconds. We should be seeing
yours,
some
bro.
movement. I think it'll be flat. I think it's like 1 to 2% up or down. 1.6% is the initial move. Now it's down. Now it's up. Now it's down.
I didn't celebrate that candle. I was like,
Now it's down.
Dude, Jose's on fire today, man. Hitting his price targets.
331 down half.
Situational gambler, Jose. What the chip just happened?
I think Jose's Serenity. Is Jose Serenity?
Yeah.
Down 1.5. Okay, Apple EPS, they beat by 7%, 202 versus 189. Revenue beat by a very small amount, 109.4 versus 108. Revenue's up 16% year over year. EPS is up 30%. And the stock is at 327.50, down 1.6. iPhone revenue, 54.2 versus 53.6. That's a beat. EPS is a beat. Revenue is a beat. By the way, AWS margins were at 39.5%. We didn't talk about that. That's probably another reason the stock's moving. I'm going to try to get the rest of their China numbers, but yeah, Apple basically down 1.5%. Not that crazy. Here's some of the coverage we've got
$5
on
trillion company though, so that's still a lot.
on Apple. Yeah, no, that's fair. That's fair.
Hey there, Mel. We've got shares just at the flat line right now, despite what is a blockbuster quarter for Apple. I'm looking at a revenue beat here of $109.42 billion versus the $108.65 billion that was expected. That is a 16% jump from a year earlier. Now, EPS is coming in at $2.02, but we're not going to compare that to estimates, at least not at this point, because it includes an 11-cent favorable impact from tariff refunds. Going down the line here, iPhone revenues, a huge beat, surging 22% year over year to $54.25 billion. That's its third straight quarter of 20% plus growth in that segment. The iPhone 17 family, their most popular lineup in company history. Services coming in slightly light at $30.74 billion versus $31.22 billion expected, but still, I mean, that category is still up 12% from a year earlier. And then China, a third straight quarter of 20% plus growth. It's up 22% to $18.8 billion. That's been a huge bright spot for them. Gross margin is coming in at 50.1%. But again, we're not going to be comparing that to estimates at this point because it includes that favorable impact of 2 percentage points from those tariff refunds. Cash on hand, we're looking at $146.5 billion. And then I just have to point to the Mac segment because it was just a blowout quarter there, $10.35 billion, beating estimates of $8.74 billion. And then just a couple minutes ago, guys, I was catching up with CEO Tim Cook back there in Apple Park. It's his final quarter, of course, as CEO, 15-year tenure before he hands over the reins to John Ternus. I specifically asked him about Chinese memory. That has been Chinese memory because of the memory supply crunch that we are faced with right now. And he said, I think memory that from any source can help because there is a fundamental supply issue in the consumer DRAM space. There's not enough. It's too expensive. So both of those things are happening at once and obviously related. Any source providing some supply would be good. So it seems like all options are on the table. Of course, CXMT, that DRAM supplier in China, just went public this week in Shanghai. And then my second question was asking about this Google partnership because so much of this upside for Apple that we've seen has been related to the company is the anti-CapEx AI bet, not spending heavily to train frontier models and licensing that tech from Gemini and from their partner Alphabet. I asked if there was any concern about that dependency. Tim Cook told me we are collaborating with Google. We're doing a lot of work ourselves as well. It's an engineering collaboration. And no, it does not bother me. I think it's very smart. Guys, calls kicking off at 5 o'clock Eastern, and that's where Cook will be addressing whether or not we see any price hikes.
Right. Mackenzie, thank you.
All right, so stock's down 2. I mean, it's a very typical quarter for Apple. It's usually up or down 1 or 2%, nothing too crazy. Anyone have any thoughts on some of those numbers that we saw?
I'm long Qualcomm, so whatever. But I do like the fact that the mobile devices did really good. So you have your laptop. I mean, even though that's not Qualcomm, like it still shows that Qualcomm's business when it comes to mobile device chips is going to be benefiting from that. But of course, Qualcomm its server segment is what is going to be the crux of that. So we'll see. But it's freaking Apple, dude.
Yeah, and also the thing pumped so hard going into the prime. It was at 340, dude. When the market was tanking, like egregiously tanking, Apple was up. So the fact that it's down 2% here, it's like it's not even a big deal, right? Mac killing it, iPhone killing it. I am confused. Who still buys iPads?
Yeah.
Has anyone bought an iPad in the past 90 days?
Families buy iPads.
Parents for kids.
Yeah.
Okay, outside of not having kids, does anyone buy an iPad anymore? I mean, I use one. I have it from 2023, but like I'm still surprised they sell 6 billion of iPads every 90 days.
They make the MacBook Pros like so mobile at this point that who the hell wants an iPad Pro when you could just buy a MacBook Pro? It's like it made sense before when you couldn't get the compute in that form factor, but now it's like, why would you buy an iPad? But I agree with Jose and I agree with Anil. Like I bought. They're still using the same iPad from like 7 years ago because they're just playing stupid Roblox on there, which is down 10%.
Dude, I literally have an iPad. The literal only reason is to look at the chat. That is I've never watched like a YouTube video on it. It's just a screen to see the chat. So I don't
never see him respond the chat.
I respond to a lot of the chat. Okay, but I know I don't really do work on here. So, but it's good, right? The 6 billion, that's 24 billion a year on iPad. A product that came out in 2010. I mean, it goes to show how locked into the ecosystem. Look at gross margins as well. 50%, which is up Q over Q and year over year.
It's a safety stock most of the time. Most of the time, it's safety stock. So, it's still up massively year to date. So it's going to give some back, especially when everything else is pumping.
40 PE, not bad.
G Money says a mint never responds to me. That's wrong, G Monies.
That's a dope name.
G Monies. That's a great name. It's a great name. Amazon, little red candle, but still. All right. Do we really think that this Amazon could reverse? This move could reverse? Like, is there any inclination that they could say something? Because this happened back in 2025. I think it was Q1 of 25 where Amazon did go. Yeah, Tanner's. You remember that, right? Like,
yeah. I think Jassy can always say something on the call or talk about forward guidance and, sweep this gain under the rug. But I don't know. It's not going to change my position in the company. These are great numbers.
Did you guys look at AXTI? They reported earnings. They were up 27% today, and they're up another 32% after hours.
Yeah, but this company is worth a couple billion. So it's not,
yeah, but
I mean, dude, this thing took a 70% haircut in the past month. So I'm sure the numbers are good. I'll pull up the numbers, but once again, it's like this one's a highly levered photonics play, right?
Yeah.
So it's like, yeah, it's nice that it's going up 50% in a day, but it was also down 50% in a few weeks.
It's still down 30% on the month.
It's still down 30% in do you think people are going to be more tired of those types of names given the volatility we experience? Or do you think if they rebound, people are like, nope, I'm going back in with leverage?
I think they're more exciting. The volatility.
Yeah.
So you think
people to speculate?
So you think experiencing the downside on many of these names is not going to stop people from getting back in effectively?
I think people are going to be careful with these smaller companies now. I mean, there's a lot of great photonic stocks out there, but these like couple $1 billion ones, some people would be like, oh, I learned my lesson, so I'm not going to do that again. Like buy freaking Cyphers, some overseas market, right? It's just, that's risky as hell. But like, companies like Credos, Light or Lumentum and all those companies, like those are actually really good companies, but buying these small ones, like they're so risky. So hopefully they learn their lesson. Or look at after hours. Yeah.
If they continue to put up these numbers, people will definitely get back in. I mean, Tesla back in 2018, 2019, the amount of capitulation, then people buying much, much higher after 2020.
No, but hold on, Tanner. Tesla is a really big company. This is a bottleneck in the photonics.
Yeah. I'm not talking specifically about AX. I'm talking more Lumentum, Coherent, like the $50 billion, $60 billion range. That's where Tesla was back in 2018.
That's fair.
All I want is like the market to pump back up and Bury to be liquidated. That would be chef's kiss.
Okay, well, I got to run. Good luck on the calls. Congrats to the long-term holders of Amazon. I just want to quickly shout out, I did a massive interview today that will be out.
Can we get the exclusive? Can we get the exclusive? Can we get the name?
You want the name?
Can we get the name?
Do you think I
don't say
should?
the name.
It's Steve.
Chat, spam the name. We want the name. Who is it?
Okay, here.
Leopold.
I'll share my screen.
Don't like Rick roll us or something.
No,
It might be Chris.
I swear. I missed my live stream and everything.
Chris.
It's Steve.
Dum, dum, dum.
Okay. At 7 o'clock, I'll be releasing this video. Just has to get approved, but hopefully you guys all enjoy. And I'll make sure to premiere it so we can all watch it together.
Uh-oh. There we go. There we go.
Should be lots of fun. Mind you, I've got another massive interview tomorrow, so I might have to miss my stream again because I'm doing a very similar interview tomorrow.
That one I do know.
How similar?
Not
Like
I
approval?
mean CEO interview, not similar that way. But this one's actually going to be in person. So I rented a studio, and
I'm very excited for that one.
yeah,
I'm very excited.
Yes.
I think I know who that one is.
maybe. All right, guys.
here we go.
See you at 7 p.m.
Yeah, congrats. We'll be watching tomorrow.
Thanks, brother.
Tanner.
Bye.
See ya.
Amazon up 7% here after hours. Was there any earnings that we missed? We looked at Roblox, looked at Apple just now, looked at Tempest, looked at Big Bear, AXTI. I mean, look, if you're in AXTI, 60% day, you got to be happy. It's a big day. Rivian's flat. Reddit, I don't know why it's down, but it's down. And then we just saw Apple. Let's get a little bit of more coverage here by one of my favorite analysts when it comes to Amazon, and kind of get his take on what he thinks is going on from Mr. Mark Mahaney.
Talked about CapEx for next year. Meta declined. Microsoft gave you some forward financial, free cash flow guidance. That's not Amazon's. That's not what they normally do. So I wouldn't expect them to talk about it for next year. And then in terms of financing, they have enough financing to get through this. This their biggest investment cycle ever. They have enough without having to tap the equity markets. I know there was this urban myth that they would do that. I strongly disagree. The last time Amazon did an equity offering, it's IPO. So they just don't do that. But a debt offering possibly, but they'll only if they feel like it's helpful to the balance sheet. Like there's no necessity on their part to raise debt if they want to, and if they wanted to, they absolutely have the ability to raise it. But I don't expect them to.
Anything else that we've missed so far, Mark? I know it's early on; the conference call hasn't happened, and you got the release. But anything else stand out to you?
Well, it sounds like we had acceleration across the board, advertising, retail, and AWS. My sense is I haven't looked at the retail margins yet, but they're probably gapping up. Now I want to find out some things. Let's talk to us about Project Leo. So are we blasting off, pardon the pun? Are we going to go commercially live in the fourth quarter? I think we will, but I'd like to hear that. And then we've got new business initiatives like this logistics and shipping initiative. So, it's only been out for a month or two, but what kind of early traction are we getting for that? Those are the two most interesting new business areas. This is when during the earnings call, they usually riff a little bit on some of their newer initiatives. I want to hear those.
All right.
All right, so that's what we got on Amazon. Monolithic Power Systems, MPWR. That stock crushed it. It was up 5% of the day, 12% after hours. This is a pretty big company, $300 billion, $64 billion market cap. Beat by 11%, 650 versus 588. Revenue 980 versus 903, beat by 9%. If anything, it's proving that energy demand continues to be incredibly strong. And, this is what we would see from a variety of these companies that continue to prove that, the data center build out requires energy. That's up 12.2% right there after hours. Is continuing to make a move. Another company, well, this was Coinbase as well. I know some people were asking for that. It looks like Bitcoin going down just kind of sucked for Coinbase. But revenue missed, transaction revenues missed, subscription services missed. I mean, it's the exact opposite of Robinhood. Robinhood beat on every single metric. They ended up not becoming profitable, lost money.
Yeah, but just look at Robinhood crypto, and this is what you get.
So, well, Robinhood crypto actually beat expectations, 100 million versus 86.
Yeah, but the business itself is super tiny now. So
that's fair.
Yeah, a Coinbase that basically only does this is not that surprising. I do have some info on the Reddit drop and what's the reason according to chat, and I checked. The total quarterly average daily actives in the United States did drop quarter over quarter a tiny bit, and it's only up 5.7%. If you look at the logged in United States quarterly average daily active user, that's only up 1%. And since the average revenue per user in the US is much higher than the rest, if that segment slows down or goes down, it's an issue. And I think that might explain the drop after hours.
I mean, that's fair. If they're losing the American users, that's probably not what the street wants to see. Next Power beat by 15%, 120 versus 104. They missed by 1% on revenue. Revenue still up 8% year over year. EPS is up 3% year over year. That stock, I believe, Oracle was up 10%. That is correct. NXT is down about 2%. So nothing too crazy. The real story here, folks, is Amazon. And we're going to see in the next 15 minutes, we'll be listening to their call, what they say about CapEx, how they think about where the broader growth of the business is going. I want to play a couple of clips right here from Skrelly, who broke this Leopold story. He was on a podcast earlier today, and here's some of the math and technical breakdown of what ended up happening, which was really the entire story of the day.
Ken is a very smart guy. He sort of shows up and says, how can I be a partner to the Goldmans and the Bank of Americas when they need to get out, of a really risky position? They basically take over the book, right? So I'll give you sort of an example. You're asking the question. So let's say, you're at 45 billion, to sort of try to trace this back, and you're 10 billion of that is in Anthropic, from what we understood. So you have $30 billion of cash in your bank account. And running 4x levered means you have 120 billion gross market value.
Oh.
So if your GMV drops, 25%, that doesn't sound so bad at 120 billion. Maybe that's, 30 billion. So you're down to 90 billion, but that's not your equity. So your equity drops from 35 billion to 5 billion.
Yeah.
And no prime broker is going to let you keep 90 billion of gross market value, because once you dip your equity below zero, it's their loss, not yours. Mm-hmm. And they're not going to lose a penny after Archegos and after these other kind of blowups. And that's not their job. And they kind of have the right to take over your portfolio, mm-hmm. which is sort of, something I hope nobody ever has to experience. But they basically call you in and say, listen, these are our assets now. Yeah. And, we're going to decide what their disposition is going to be.
TBVN.
Interestingly, we heard that 3 firms were bidding on the assets. So Jane Street, Millennium, and Citadel were sort of brought in a closed circle, sort of late Friday to bid on the remains of the firm. And we got offered a look at $100 million of Anthropic stock, which we were puzzled by. Sometimes you see these SPVs, sort of interest comes across, here and there. And we thought that was interesting. I sort of raised my eyebrow and was like, is that Leopold? It's because, sometimes when you want to sell $4 billion or something, you don't come out and say you want to sell $4 billion. You come out and you say, you want to sell $100 million of it. And usually a guy who wants to buy 100 is enough to buy 500 or more. Yeah. And you sort of fill them out and say, here's 100. Okay, do you want 5 by any chance? And then, your eyebrow starts to raise a little bit that, maybe he's got even more. Now, of course, this is a really odd situation. So we heard Millennium did put in a bid. Citadel's bid was better. Mm-hmm. I think Ken wants to be the guy that everyone goes to when they're in trouble.
How's your last? Take us through it.
History. Mm-hmm. I was talking to some friends last night about long-term capital management, Amaranth, other famous liquidity-driven blowups. Mm-hmm. And this is up there. It's just a really crazy thing. We had heard rumors sort of mid last week, and then they really started crystallizing last night. And this morning, obviously, sort of a fait accompli. And I actually think they did a wonderful job of keeping it relatively quiet. I think some players were already positioning, say, early in the week, Monday, Tuesday, looking to do what my old boss Kramer used to call, shooting against a fund. So if you know somebody has to liquidate, the best thing for you to do, unfortunately, sadly, Darwinian, is to go sell all the positions you have in common and then go start shorting everything they have. Yeah. And it accelerates the sort of downfall as quickly as you can. And this.
An absolutely crazy day. Sam, I know you've been tracking the story since last night. Just general thoughts on how you think this will continue to play out over the coming weeks.
I mean, that's obviously the market didn't drop that, or semiconductors didn't drop that much because of Leopold. It was just one of the factors of what happened as a result of the drop. Just ultra levered people. We saw it happen in South Korea with the Kospi and everything. What we need to know, though, is that he went belly up, but a lot of people probably went belly up even before that, too. So it wasn't just him. But this guy is like the icon of AI as far as like those secondary players, Bloom Energy, Nebius, CoreWeave, IREN, all these other companies, SanDisk, Micron. And him going belly up is a great indicator that, like, look, at some point, you need to take profit. You can't just keep letting things run. And I've learned that lesson myself. Even like recently, I learned that lesson myself. But dude, greed even hits people who are like extremely smart, doing really well in the affluent nation, whatever. Like they have emotional behavior as well. And Kiss literally got the best. Like that was actually really good what he said. I didn't really think about it that way for some reason, is that if you're 4 times levered and you're down 25%, you basically just lost your entire book. Yeah. Right there. Like that's freaking scary, man. And this is a great lesson learned because it didn't just happen to some retail guy on Twitter and Path or Lemonade, whatever, all the stocks he was in. It happened to a very well affluential person who worked at the top frontier modeling company in the world besides Anthropic. It's kind of sad, actually.
Neil, any thoughts? You're muted, Neil.
Correct. This whole saga could be a good mini series, like a mini series about this whole AI build out. We could contact Andrew Sorkin. I know he's working on 1929 TV show and some other stuff, but this here is, I mean, prime absolute cinema. This is incredible.
I agree. Apple down 4. Usually Apple needs the call to, I mean, last time on the call it flipped green, so we're going to see what they see on the call. Jose, anything you got on Amazon and the robotics sector? I know Jassy will probably talk about that as well.
Yeah, I thought it was cool. In their press release, they mentioned that they introduced the next generation of one of their robots that's meant for moving goods up to 1,300 pounds. But the thing that I found pretty cool is they mentioned that they're using AI and employees can now direct this robot with plain conversational language. And we know Amazon is a robotics company, but I think just showcasing that now AI can actually help. I think if you go down a little bit more, it's more like in the middle. Probably even closer to that one. But just showcasing that now they're using natural language to kind of control these robots definitely showcases that we're almost at the Terminator level. So I don't know if that's good or bad news, but that's pretty cool.
Yeah, the robotics stuff is really interesting. Tesla and Amazon should be big winners. Amazon's already done so much in robotics. It's that kind of humanoid robotic revolution that should be good for the semis, should obviously be good for NVIDIA, should be good for the hyperscalers. I think the street's still waiting on that. And I would imagine something like this is Amazon's way of working up to scale that product. Rashil says, I've seen that product in person. Pretty cool. Yeah, I think, folks, look, it was a great quarter. Operating margins are up. Net income's up. Revenue's up. Like the real big thing is AWS beat every expectation it needed to beat. It's just that CapEx number, which, by the way, I think it's going to take us almost 20 minutes into the call for us to get that number. And I think 2026 is 200, right? Or is it 220? It's 200. Okay, so if it's 205, I don't think the street cares. If they raise it to like 220, I think the street cares. I don't think they give us 2027 guide, and I don't think it's going below 200. So if it kind of just stays in that 200, 205 range, same thing with Microsoft. Maybe that's enough for the street to just. It's so funny, dude. We need the street to ignore Amazon spending on CapEx because apparently that's bad, even though all that CapEx is what's led to this growth. Yeah. It's such a weird space we're in, but
I also wonder if the only 2 players that really have a good AI chip right now are Amazon and Google. And Google increased their CapEx. I wonder if it really has to do with them also just building more of their AI chips as well. Microsoft, unfortunately, while they do have an AI chip, it's not as crazy. So that also kind of controls their CapEx. They can only buy so much from NVIDIA and some of these other players, where these other ones can actually buy from them and also build their own. So I would be surprised if they don't increase CapEx now that I just said that.
So CapEx expectations for the fiscal year sits at $202.4 billion as of right now. For next year, it's 235 billion, but the range is insane. Like the top number is 304 billion for fiscal year 27. So add another $100 billion for next year, according to one or maybe a couple of analysts. But for this year, it's already at 202.4. So even if it's 205, I don't think the market will care.
Nick says, does anyone find it odd that no one is saying anything about 2027? Yes and no. No, because they technically don't need to give the next year's guide. Yes, because like the Microsoft thing, honestly, I think Microsoft should have pumped because it's Microsoft and it shouldn't be down this much. And they did accelerate Q over Q. But like them not giving the 2027 guide was enough for the street to be like, it's okay. You know, we don't have to worry about it until we have to worry about it. So let's take the stock up. And Meta increasing the bottom half of their guide for 26, not 27, was enough for the street to tank it. Now, Meta had some other issues, but
I feel like they all have said, right? I mean, Google, not direct number, but Google directly said that they're going to be increasing meaningfully. And Microsoft said that fiscal year 2027 CapEx is going to grow, not calendar year of 2026. So they're pretty much saying exactly what Google just said, that 2027 CapEx is going to continue to grow. I think Meta was the only one that didn't really give even a commentary of the trajectory of CapEx for 2027, but the other two did mention growth was coming.
Yeah, like you said, Jose, they are in fiscal 27, Microsoft. Yeah. So 12 months from now, we're halfway through 2027 calendar year for a Microsoft.
Yeah. So they just ended their fiscal year. So they mentioned for calendar year 2026, there wasn't going to be any raise. But they mentioned so for the other one, for fiscal year 2027, so the 2 quarters that are in calendar year 2027, we are seeing CapEx growth. So like that's what I meant to say, was like the commentary for 2027 is still strong for everybody except Meta, who didn't give us a direction.
No, but then why did Google dump? I guess is the question. If it was all, because you can't point to the numbers for why Google dumped, right?
I think it was, everybody was expecting Amazon to be free cash flow negative, or at least most people. I don't think we were expecting Google to happen this quarter. I think it was expected to happen. I just think the street didn't expect it to happen this quarter. And they were like, you know what? We're going broke for AI.
That's fair.
So also the day after Google dump, they were green and they've recovered pretty decently since those earnings. So it was just a matter of how the market was digesting all of the macro news at the same time, and the war was escalating, all that crap. But if you look in the last week, mega caps haven't, besides Amazon, of course, and Meta, not all of them have dumped tremendously in the last week. Some of them actually recovered pretty nicely. And if you look at Google right now, Google is at 334, so it was like 315 the other week.
It was at 340 before the earnings, but yeah, I mean, relatively, that is fair. I guess Tesla's the one where the CapEx led to no level of meaningful ROI, and that one is still not recovered at all. And then you're right, Jose, Meta did say they're spending more in 2027, but Zuckerberg did not double down on the AWS compute type of business that would be the beneficiary of the CapEx. It was back to like Meta Superintelligence, which is maybe what the street didn't want to hear.
Apple down 4.5% now.
Okay, this Amazon call should be starting very soon. Once it's live.
The day Microsoft bottomed is the day Micron peaked. The exact day. Peculiar.
So what's the conspiracy theory here, Neil?
I don't know. I'm trying to make one up, but I.
Wait, what did you say? The day Micron.
The day Microsoft bottomed at, what was it, 350 or something, is the day Micron peaked at 1,200 and some change.
Huh. Yeah, you're right.
Interesting, huh?
Is Nadella shorting Micron to run them out of business or something? Like, dude, what if the Mac 7 just made their own hedge fund and started shorting their suppliers and was like, dude, you guys are getting these prices down one way or another?
That is kind of what
CoreWeave. It's the core weave move.
That is kind of what farmers do, right? Don't they buy their crops and like they short the commodity or something like that? I'm not in that game, but don't they do that to like hedge inflation on the products they're buying?
Potentially. I'm not sure, but I mean, the fact that CoreWeave is buying puts on memory is
Allegedly.
Yeah.
At the bottom.
All right, Amazon call. We'll be here in the chat. We'll keep you updated on any other earnings updates, but the number we're looking for is in CapEx. We should get it in 20, 25 minutes, and then we'll see if the stock reacts positively or negatively. Hopefully, they keep it relatively flat to slightly up, and that's enough to keep this going.
During this call, we may discuss certain non-GAAP financial measures. In our press release, slides accompanying this webcast, and our filings with the SEC, each of which is posted on our IR website, you will find additional disclosures regarding these non-GAAP measures, including reconciliations of these measures with comparable GAAP measures. Our guidance incorporates the order trends that we've seen to date and what we believe today to be appropriate assumptions. Our results are inherently unpredictable and may be materially affected by many factors, including fluctuations in foreign exchange rates and energy prices, changes in global economic and geopolitical conditions, tariff and trade policies, resource and supply volatility, including for memory chips, and customer demand and spending, including the impact of recessionary fears, inflation, interest rates, regional labor market constraints, world events, the rate of growth of the internet, online commerce, cloud services, and new and emerging technologies, and the various factors detailed in our filings with the SEC. Our guidance assumes, among other things, that we don't conclude any additional business acquisitions, restructurings, or legal settlements. It's not possible to accurately predict demand for our goods and services, and therefore our actual results could differ materially from our guidance. And now I'll turn the call over to Andy.
Thanks, Dave. We're reporting $200.6 billion in revenue, up 20% year over year. Operating income was $27.5 billion, up 43% year over year. Q2 was another very strong quarter for Amazon. I'll start with AWS, which is booming right now, and I'll share the numbers, what we think's going on, and why we're enthusiastic about the ROIC equation, even with heavy CapEx the next 2 years. First, the numbers. Revenue growth of 36.7% year over year, accelerating for the 5th straight quarter, our fastest growth in 18 quarters back when AWS was less than half its current revenue size. We added over $4.6 billion in revenue quarter over quarter, about 80% more than our largest increase ever. And our backlog stands at $496 billion, growing triple digits year over year. AWS is now a $169 billion annualized revenue run rate business, which for perspective would place it 24th on the Fortune 500 list if it was a standalone company. Our chips business now has an annual revenue run rate of over $25 billion, growing triple-digit percentages year over year. Our AI revenue run rate climbed significantly quarter over quarter, is now also over $25 billion, growing triple-digit percentages year over year. Customers choose AWS because we offer the broadest capabilities. They want their AI inference to reside near their other applications and data, and more of it resides in AWS than anywhere else, and because AWS has the strongest security and operational performance. We're seeing strong growth across both AI and non-AI, what we call core, and growth in one is driving growth in the other. Growth in AI drives core because post-training reinforcement learning and agent tool use is mostly done on CPUs versus AI accelerators. This is an advantage for AWS as our Graviton chip is the strongest CPU chip, offering up to 30 to 40% better price performance than other options. You need a place to store this AI data and to run vector databases, which are also emblematic of a meaningful edge for AWS because we have the broadest and most capable functionality by a fair bit in these core infrastructure areas. We feel similarly about the AI stack, top to bottom. We have a unique offering that customers are excited about. As we've been saying for 18 months now, technically competent companies are going to build their own foundation models, not the really big frontier models, but smaller models that leverage their proprietary data. There's no easier service for this than our SageMaker AI service. Customers also need a high-performance, cost-effective inference service, and that's what Amazon Bedrock provides. Bedrock not only provides the best selection of leading models at superior performance and with the governance and security controls that companies need, it's also continuing to grow incredibly quickly. In addition to leading model building and inference services, customers need easier ways to build, run, and leverage agents. For example, even after you've built an agent, you have a lot of muck to worry about. A production agent needs somewhere secure to run, memory so it holds context, an identity so it can act on a user's behalf, tools and data to connect to, and a way to watch what it's doing once real traffic hits. Stitching all that together reliably is hard, and it's stalled many production deployments. It's why we've built Bedrock Agent Core. It provides building blocks as managed infrastructure, and our teams keep iterating, recently adding features like policies, which give companies deterministic controls over what agents can do, payments so agents can execute transactions autonomously, web search to ground agents' knowledge without having to leave AWS, and a new harness that further speeds up how fast customers can put this all together, including creating the agent with strands. While companies will construct their own purpose-built agents from the ground up, most will also use turnkey agentic services. Coding agents are a good example, and there are several successful ones, including Claude Code, Codex, and our own spec-driven Kiro, which is up to 50% more cost-effective than others and tripled in usage quarter over quarter. Another of these agentic services is Amazon Quick, an intelligent AI work companion that helps you manage, search, and automate your digital workload across email, calendar, local or cloud files, and custom workflows. Unlike other offerings in this space, Quick also lets you manage across leading SaaS tools like Slack, Salesforce, Jira, Teams, and ServiceNow. Quick enforces a company's existing access controls so each person sees only what they're cleared to see, and then it takes action, scheduling meetings, drafting and sending email, updating a CRM record, building a dashboard, and more. In Q2, we made Quick even more capable, adding autonomous agents that customers set up in plain language to run continuously in the background and carry out multi-step tasks. A personalized activity feed that pulls email, messages, calendars, and tasks into one prioritized view, and 16 new integrations, including Adobe, Moody's, and Snowflake. Quick has momentum, with 3M, Allianz, AstraZeneca, Autodesk, BMW, Exxon, FINRA, Hyundai, Intuit, Mondelez, Moody's, the NBA, the NFL, Life Insurance, and Southwest Airlines all using it. We also have services like Amazon Connect, our call center service, and AWS Transform, which automates software migration, growing quickly. I'll mention one more that I'm excited about. As frontier models get increasingly powerful, they're making it easier to find security vulnerabilities in technical applications, many of which humans haven't found. This is obviously concerning for companies that protect important data. We recently released AWS Continuum, which discovers, prioritizes, validates, and remediates code vulnerabilities. It starts by ingesting the backlog of vulnerabilities a team already has, and then leverages the new frontier models to run comprehensive scans. Continuum uses agents in each company's own business context to prioritize what matters, reasoning through questions like, is the affected component deployed? Is it reachable? Is it in a production path? And what's the impact if it's exploited? It then validates vulnerabilities in a sandbox so teams aren't chasing false positives. And finally, it recommends the fix. It's hard to talk with enterprises about AI right now without their mentioning security, and we expect Continuum to grow quickly. I mentioned earlier that our chips revenue run rate is now over $25 billion. We're unusually well positioned for this AI inflection, given our leading price performance chips in both AI with Trainium and CPU with Graviton. In addition to the two leading AI labs in the world, Anthropic and OpenAI, making multi-year, multi-gigawatt commitments to Trainium, an increasing number of AI startups are also adopting Trainium, including unicorns like Neurorobotics and Odyssey, joining startups like 12 Labs, Descartes, Poolside, Karakuri, Metagenomics, Neto AI, and Splash Music, and larger companies like Uber and Pinterest all adopting Trainium. Graviton is used by 98% of our top 1,000 EC2 customers. The revenue commitments have increased nearly 3 times quarter over quarter, and Graviton 5 is growing nearly 2x faster as Graviton 4 did. We also continue to have a deep partnership with NVIDIA, and will continue making AWS the best place to run NVIDIA chips, as we have customers who will run on NVIDIA for as long as we can foresee, and we believe strongly that customers want choice. Choice is good for customers, competition, and driving the cost of inference down, which customers care deeply about. Let me talk for a second about how we see this investment playing out. Earlier this year, we said we plan to invest approximately $200 billion in cash CapEx in 2026, the majority of which to support AI and AWS. At this level of spend and higher, we have clear line of sight to strong financial returns. I'll explain why. There are two major parts of the investment: the data centers and the servers and networking equipment that go into them. These have different capital cycles. Data center capital is spent starting 2 years before we can put servers into them to start monetizing. Once a data center opens with servers plugged in, we start generating significant revenue right away and then get to monetize these data centers for 30 plus years without having to spend that startup capital again. Servers and networking equipment operate on a shorter cycle. We typically purchase these a few months before putting them into service, so we have strong visibility into customer demand before we trigger the spend. If the demand isn't there, we won't spend the capital. For servers and networking equipment, on average, it takes a little less than 3 years to break even on that investment. The servers currently have a useful life of at least 5 to 6 years. And most of our AI capacity these days is being contracted for at least 5-year terms. That means that we're driving significant free cash flow on the servers and networking equipment in the 2 to 3 years after we break even. It's also worth noting that AWS has a strong track record of pulling forward break-evens on server equipment, where we've already made meaningful progress, and finding ways to extend the useful life of this equipment without sacrificing customer experience. So for our data centers, which have 30-plus year useful lives, we should get at least 5 to 6 generations of server economics like I explained earlier, with subsequent generations after the first having even better overall economics because we don't have to repeat that upfront data center investment I mentioned earlier. This means in the short term, when demand is necessitating so many data centers being built simultaneously in advance of when we can start monetizing them, we'll spend a lot of CapEx and encounter free cash flow headwinds until these data centers come online, can be monetized, and we get a few years into these servers being utilized. But as we get a few years out, and the revenue growth outpaces the incremental CapEx growth, which will happen at some point, the resulting revenue, free cash flow, and return on invested capital is very compelling. We've done this before in the first era of cloud computing, just over a longer time horizon, where demand built more gradually than it has in AI. But we see the margins and returns in AI tracking what we saw with core at the same point of evolution, actually a little ahead. We now believe we will spend approximately $220 billion in cash CapEx in 2026, the higher cost of memory pushing this number up from our prior estimate of about $200 billion. But even at that amount, we will still not have enough capacity to meet all of the demand we have in 2026. And I believe this dynamic will also be true in 2027 too. In fact, the demand we already have for 2028 is striking. And remember, enterprises are still very early in using inference at scale in their current production applications. We long believed AWS could become a few $100 billion revenue business, and now believe it'll be at least double that, and very possibly be a $1 trillion annual revenue business for us in time, with very appealing accompanying free cash flow and return on invested capital. I'll now turn to stores. We added millions of new products to our select.
All right, folks, that was it. Amazon, $220 billion of CapEx, up from $200 billion. The stock is holding on. Jassy just said AWS could do $1 trillion of revenue. Any quick reaction from you guys? But Street likes it.
Wow. I thought these comments on the free cash flow coming in and expanding the server life was actually good commentary.
The fact that it's not budging here means that the Street's believing the ROI is going to happen.
Including over 700,000 from notable brands. We also expanded ultra-low price selection on Amazon Haul in the US by nearly 20x since launch, and now have over 6 million items priced under $10. We continue offering everyday low price events. Fresh groceries now make up 6 of the top 20 bestsellers on Amazon.com. We grew the number of new customers for Amazon Pharmacy by more than 2x in the first 6 months of the year, and same-day prescription deliveries nearly 5x. We also saved customers nearly $250 million so far this year in out-of-pocket costs, up more than 400% year over year. We continue speeding up overall delivery and once again achieved record delivery speeds for customers in the first half of the year. We offer millions of items for same-day delivery with Prime, up to 40 times more selection than a typical big box retail store, and our same-day network continues to expand. Globally, we delivered over 40% more items same day or overnight in the first 6 months of the year than the same period last year. We also continue to expand our ultra-fast service, Amazon Now, which offers delivery in 30 minutes or less on thousands of everyday essentials. We added 80 new cities and towns across the U.S. and several major cities in Egypt in Q2. And Amazon Now is available in 9 countries and over 250 cities and towns globally. We continue to see strong customer response with over 80% growth in gross sales and units sold quarter over quarter, and we served over 60% more customers quarter over quarter. We recently launched Amazon Supply Chain Services, so any business can move, store, and deliver everything from raw materials to finished products using the same supply chain that supports Amazon. And we already have several large customers, including Procter & Gamble, 3M, Lands' End, and American Eagle Outfitters. The stores team also continues to innovate and deliver for customers with AI. Customers love Alexa for Shopping, our agentic AI shopping assistant. It offers personalized recommendations, product comparisons, price history, and the ability to automate shopping through features like price alerts and auto buy. Over 350 million customers have used it in the last 12 months, and engagement accelerated in Q2, with active users nearly doubling and interactions up over 5x year over year. We also expanded Amazon Lens, which lets customers take a photo of anything they see and instantly find the same or similar items on Amazon, to 10 additional countries. It's now available in 21 countries around the world. Moving on to Amazon Ads, we saw strong growth across our offerings, generating $19.8 billion of revenue, up 26% year over year. Sponsored products continues to be our largest offering and a key driver of growth. Additionally, increasingly more shoppers are discovering products in our agentic and conversational experiences, including in Alexa Plus and Alexa for Shopping. Shoppers who click a sponsored prompt convert to a sale 48% more often and spend 21% more on average than those who don't. We see continued growth and engagement in Prime Video ads and live sports. We introduced more than 30 new advertisers to the NBA in our first year, and inventory on Thursday Night Football, NBA, WNBA, and NASCAR all sold out. Advertisers are increasingly investing in multi-sport strategies, with brands activating across multiple sports, seeing 2.3 times higher unduplicated reach compared to single sport advertisers, and multi-sport viewers are driving 12% higher spend and 17% more orders on Amazon. And finally, we make it easy to create, launch, and optimize full funnel campaigns using AI-powered tools, including Ads Agent, which turns hours of setup and targeting into minutes. Advertisers using Ads Agent targeting see 8% lower cost per impression and 6% lower cost per acquisition, and we've expanded it to 11 new countries this year. We're also continuing to see momentum in several other areas, and I'll mention just a few. Starting with entertainment, the inaugural season of NBA on Prime Video delivered strong viewership, with a peak of 6.5 million U.S. viewers for Game 7 of the Eastern Conference semifinals, outperforming Game 7 on broadcast a year ago. In Europe, viewership of the NBA more than doubled year over year on Prime Video, with the highest average viewership on record. We also drew 36 million viewers globally for the series premiere of Off Campus on Prime Video in its first 12 days, becoming Prime Video's #3 top-viewed series debut ever. Alexa Plus expanded to Germany, Austria, France, and Brazil, and hundreds of millions of customers are using new Alexa experiences. We find that everywhere Alexa goes, it drives momentum for the business. For example, in the U.S., customers who use Alexa for Shopping spend an average of over 40% more per order than those who don't. And customers who've tried Alexa Plus are signing up for Prime at nearly 25% higher rates. And finally, Amazon Leo is close to 400 satellites in orbit, enough to begin initial satellite internet service this year. We already have meaningful revenue commitments from enterprises and government customers, and we have more than 20 partners who will extend the reach of our network across the globe. We continue to be in the middle of some of the biggest inflections of our lifetime, and we're building multiple new long-term businesses that will make customers' lives better and easier and lead to substantial free cash flow and return invested capital for our shareholders and business. With that, I'll turn it over to Brian.
Thanks, Andy. Starting with our top-line financial results, worldwide revenue was $200.6 billion, a 20% increase year-over-year, excluding the impact of foreign exchange. These results include a timing shift of Prime Day into Q2 for most of our largest countries, including the United States. In Q2, we reported worldwide operating income of $27.5 billion. This includes the benefit from two items that reduced expenses by approximately $1.2 billion during the quarter. First, we received tariff-related refunds of approximately $600 million. This is included in our North America segment and represents the significant majority of refunds we expect to receive. Second, we recorded a separate benefit of approximately $600 million related to the change in fair value measurement of energy contracts subject to derivative accounting. This primarily impacts the AWS segment. These energy contracts are to secure electricity supply for existing and future operations. Certain terms in these contracts cause them to be subject to derivative accounting. Derivatives are measured at fair value each reporting period, and changes in fair value measurements will create unrealized gains and losses recorded within operating expenses on our statements of operations. While the impact of these fair value measurements can vary, these adjustments have not been significant in prior quarters. Moving on to our segment results. In the North America segment, second quarter revenue was $116.2 billion, an increase of 16% year-over-year. International segment revenue was $42.2 billion, an increase of 15% year-over-year, excluding the impact of foreign exchange. Worldwide paid units grew 17% year-over-year. Prime remains a key pillar of our business, and our double-digit year-over-year membership growth reflects the value our offerings deliver at scale. We saw broad-based momentum across the inputs that drive our customer experience, including new selection, sharp prices, and fast delivery. Shifting to profitability, North America segment operating income was $9.1 billion, with an operating margin of 7.9%. International segment operating income was $1.7 billion, with an operating margin of 4.1%. In our fulfillment network, we made progress optimizing inventory placement, shortening shipping distances, reducing touches per package, and improving consolidation rates. We're expanding our deployment of robotics and automation, which have been integral to our operations for decades. We're retrofitting our facilities with our latest generation technology, and we expect to more than double our fleet of robotic arms, like Cardinal and Sparrow, in 2026. We continue to lower our overall cost to serve, even as we faced heightened transportation costs driven by fuel inflation from the conflict in the Middle East and higher line haul rates from driver capacity limitations. Excluding the impact of higher fuel and line haul rates, shipping costs grew more slowly than worldwide unit growth at a pace that is relatively consistent with last quarter. On the operating income side, the impact of these higher costs is partially offset by our FBA fuel and logistics surcharge that was implemented in April. Looking ahead, we see meaningful opportunities to further enhance productivity across our global fulfillment network, all while continuing to raise the bar in delivery speed. While our operating margin may fluctuate and progress may not always be linear, we take a deliberate approach to achieving sustained long-term improvement in our cost to serve. Moving to the AWS segment, revenue was $42.2 billion, up 36.7% year-over-year, driven by both core and AI services. AWS now has an annualized revenue run rate of $169 billion. Customers continue to increase cloud migrations and scale up their use of AWS core services. And increasingly, customers seeking the full benefits of AI are accelerating their transition to the cloud. We see a strong linkage between AI spend and core growth. As customers invest in AI, we see a corresponding increase in core consumption. We expect this relationship to strengthen over time as more AI workloads move into full-scale production and drive additional demand for our core services. AWS operating income was $16.6 billion, which reflects our strong growth coupled with our focus on driving efficiencies across the business. Our investments in software and process improvements optimize server capacity and help to develop a more efficient network using our lower cost custom silicon and custom network gear. Now turning to our cash CapEx, which is $53.1 billion in Q2. This primarily relates to AWS and generative AI as we invest to support strong customer demand. We'll continue to make significant investments, especially in generative AI, as we believe it to be a massive opportunity with the potential to drive long-term revenue and free cash flow. Before moving on to guidance, I'll briefly touch on the impact from the tariff-related refunds on our results. We are participating in the tariff refund process, and as I mentioned earlier, we received approximately $600 million in Q2. The amount is limited for a couple of reasons. First, our teams did a lot of work forward buying and pre-positioning inventory to avoid tariff costs. Second, we are not the importer of record for the large majority of items sold in our store, given suppliers typically handle imports and pay relevant tariffs. In cases where we did see an increase in costs due to tariffs, we largely absorbed these costs rather than pass them on to customers. You can see that in how we stayed very sharp in our price throughout the last year, with our product prices on average 14% less than other retailers, according to third-party research firm Profitero. We have identified a limited set of circumstances where we can trace that we pass specific import charges on to customers, and when we receive those refunds, we will proactively contact affected customers and automatically issue refunds to them. Otherwise, like other large retailers, we'll utilize refunds to continue to invest in low prices for customers. I'll finish with our financial guidance. Q3 net sales are expected to be between $197 billion and $202 billion. I'll call out two areas that are driving the sequential deceleration in net sales growth from Q2 to Q3. First, Prime Day timing shifted this year with the sales event occurring in Q2 for most of our large countries, including the US. In 2025, Prime Day was entirely in Q3. Excluding the impact of Prime Day in both 2025 and 2026, third quarter 2026 year-over-year growth would have been nearly 400 basis points higher. We recognize that the timing shift of Prime Day creates some noise in the modeling of our financial results. However, after adjusting for Prime Day, as we look across our stores business heading into Q3, we see strong customer engagement, growth, and a continuation of the trends that we have seen in the first half of the year. Second, the Q3 guidance anticipates an unfavorable impact of approximately 80 basis points from the year-over-year changes in foreign exchange rates based on current rates. Q3 operating income is expected to be between $22.5 billion and $26.5 billion. I want to thank our teams across the company for their hard work and focus on customers. We'll continue to work to deliver more value to the broad range of customers we serve across each of our businesses, which is the only reliable way to create lasting value for our shareholders. With that, let's move on to your questions.
Thank you. At this time, we will now open the call up for questions. We ask each caller to please limit yourself to one question. If you would like to ask a question, please press star one on your keypad. We ask that when you pose your question, you pick up your handsets to provide optimum sound quality. Once again, to initiate a question, please press star, then one on your touch-tone telephone at this time. Please hold while we poll for questions. And the first question comes from the line of Doug Anmuth with JP Morgan. Please proceed.
Great. Thanks for taking questions. Just one for Brian, one for Andy. Brian, many have assumed that AI workloads would be lower margin, at least near term. Can you just talk about the drivers of the 39% AWS operating margin in 2Q and just how we should think about sustainability? And then, Andy, strong Bedrock traction with customers spending more in the quarter than in all the prior quarters combined. But when you think about the full stack offering, does Amazon need its own leading model toward the frontier? Thank you.
Doug, let me start with the first question. Yes, we're pleased with the growth in both revenue and also margin expansion that we had in AWS in Q2, especially given the size of our business. You're seeing, despite the large investments, AWS margins have continued to remain strong, and we're up 650 basis points year over year. 520 basis points if you exclude the derivative accounting gain that I mentioned. You know, we've said before these margins will fluctuate. They're based on a number of factors, including our investment levels, mix of products, mix of AI versus non-AI. But I would say that the profitability you're seeing from AWS isn't random. It's a result of disciplined efficiency gains, capacity optimization, which we benefited quite a bit from in Q2, and always closely managing our fixed costs. So again, they'll fluctuate, but very strong performance year over year, and we'll take it.
Yeah, I'll just add one other thing to what Brian said, which is, as I mentioned in my opening comments, we see the AI business following very much the same type of margin trajectory that we saw in the core business before, and it's a little bit ahead of that pace that we saw. So we're optimistic about that. On the question about Bedrock and our own frontier model, so you know, my view of it is that AWS and Amazon can have a wildly successful business without its own frontier model, and a lot of that is because there is not going to be one model to rule the world. You already see that right now. You see it. It's not just Anthropic or it's not just OpenAI. You see increasingly more and more companies being interested in the open models as well. And we have all of them in Bedrock. And it's one of the many reasons why Bedrock is growing so quickly. If you're a company that's building important AI applications, you want to make sure that you have the ability to use all the available models. They're going to each leapfrog each other at different times. They're going to have lots of different models that actually are comparable in capabilities. And you want that leading selection with the right price performance and with the right governance and security. And there's nothing like Bedrock that provides that right now. And you know, we use those models as well. All that said, we are pursuing our own frontier model, and we're doing it for a few reasons. First of which is it just gives us additional control over cost for our own consumer applications, but also we're trying to drive costs down for customers. And having a player like ourselves that's always focused on trying to take the price performance and the cost down for customers all the time, we think will help keep the models more cost effective for customers. I think also it allows us to have more control over prioritization on what models focus on. And we have, both from our own external customers as well as our internal customers inside the company, certain priorities that matter that we want the models trained especially well for. And then it gives us some control on speed. And so my view of it is that, within the next few years, you're going to have at least a half dozen models that are comparably good to each other. They'll all be in Bedrock, and one of them will be ours.
Thank you. The next question comes from the line of Justin Post with Bank of America. Please proceed with your question.
Great. Thank you. Just thinking about the AWS acceleration, was that really driven by a lot of capacity coming online in the quarter? You guys have been more open than your peers on gigawatts you're adding. Any help you can give us on how much you might be adding in the second half versus the first half, and also how you're thinking about 27? Thank you.
Yeah, I think that there are several reasons for why we saw such significant growth, and it's we're really pleased and excited. Fifth straight acceleration quarter, largest acceleration in 18 quarters. I think there are several things that are driving it. I think the first part is that customers are choosing AWS in part because it has the broadest functionality across both cloud core and AI, in part because it has the strongest operational performance and security, and in part because as more and more companies are bringing their inference workloads to production, they want it to live near the rest of their workloads and data, and so much more of it lives in AWS than anywhere else. I think there are a couple other things going on here on the core side. I mean, AI is obviously growing at a very rapid rate, as we talked about, well over $25 billion in annual revenue run rate at this point. But the core business is growing very quickly as well. And I think there's at least a couple things at play. One is that increasingly more enterprises are building their transformation plan to move from on-premises to the cloud. Remember, by the way,
that 85% of the global IT spend is still on premises. That equation is going to flip in the next 10 to 20 years. And you see more and more enterprises that are moving and building plans to move to the cloud, and we're winning the lion's share of those with the capabilities I mentioned earlier and the advantages. And then AI is growing, at such a rapid rate, and it's pulling along core alongside of it. And that's because the post-training and the reinforcement learning and all the agentic tool use is being driven on CPU and core. And with the leading CPU chip and Graviton, it makes AWS an even more attractive choice. So yes, we're adding a lot of capacity, but there are a lot of other reasons why it's growing. I expect that we will, we're on pace with the capacity build that we talked about a few quarters ago, where we said we expect to have double the capacity, power capacity by the end of 27 that we had in 25, and we continue to be on that track.
Thank you. The next question comes from the line of Brian Nowak with Morgan Stanley. Please proceed with your question.
Thanks for taking my questions. I have two, Andy. I appreciate the color on the long-lived data centers investments versus the server and network investments. Just the question is, as you sort of look into 2027, you look at the demand that's coming, et cetera, are you at a point where you're going to be able to start to slow that long-lived data center spend at all in 27, or is that just too soon, where you're still going to have to be opening up new data centers for the next 2, 3, 4 years as you look into 27? That's number one. Second one, in the past 90 days or so, the company talked publicly about selling Trainium at some point to third-party data centers. How do you think about when you could do that, and just sort of the ROIC on that versus core AWS loads?
Well, on the first question, Brian, we have so much demand right now. Apart from what we've talked about in 26, the lion's share of capacity in 27, and we're adding a lot of capacity, as I mentioned just a few minutes ago, is largely reserved. And we have quite a bit of capacity that's already been reserved for 28. And so I think it's actually kind of useful to look at least our view of what we see in the demand and adoption curve right now, which is we see this adoption curve in AI right now is very barbelled. There is, on one end of the barbell, the AI labs are consuming gobs and gobs of compute, and there are a few runaway successful generative AI applications like Claude Code and ChatGPT. And on the other end of the barbell are enterprises who are getting real value from AI in cost avoidance and productivity. And these are things like automating customer service or business process automation or fraud or things like that. In the middle of the barbell is all of the current enterprise production workloads, some of which are using inference in a pervasive way, but most of which aren't. And that is going to change very significantly over time. And that will be, in my opinion, that will be the largest absolute segment, the existing production workloads in the enterprise and new businesses and workloads that startups build too. And so I think we're still in the relative early stages of how much demand there's going to be for AI. I think it's going to change every customer experience that we know. I think that it will invent all sorts of new ones that we never imagined. And I don't know if the trajectory of that middle part of the barbell will be the same wildly steep trajectory that we've seen with the current barbell AI labs piece. But we have a lot of demand in front of us, and we're going to invest in this business to continue to be the significant market segment leader that we are today. We think, as I mentioned earlier, it has the potential to be $1 trillion revenue business for AWS, and we intend on continuing to be the leaders. On the question about selling Trainium, we're quite excited about what's happening in our chips business. As I mentioned earlier, it's over $25 billion in annual revenue at this point. We think we have the leading price performance chip in both the AI space with Trainium and in the CPU space with Graviton. The fact that we have multi-year, multi-gigawatt commitments from the two largest AI labs, Anthropic and OpenAI, and more companies, as I mentioned in my opening comments, using Trainium is exciting and promising. And we just have an incredible amount of demand for Trainium. So there are a lot of customers who are very excited about using it in the form that we're providing right now. We do have an increasing number of customers who are interested in us providing the Trainium chips to them separate from, even from our cloud. And we're actively having those conversations and exploring, and I expect there's a real chance we'll do that in the future.
Thank you. The next question comes from the line of Colin Sebastian with Baird. Please proceed with your question.
Yeah, good afternoon. Thanks very much. Andy, is it fair to say that there's a more concerted effort to move into the application layer with Kiro and Transform, and I guess more broadly plans for workplace productivity tools? And do you see those as sort of providing a boost to the broader platform offering from infrastructure on up? And then Brian, I mean, just given the demand signals you guys are both talking about and plans for additional capacity, what are your current thoughts on sources of capital for the build out over the next couple of years? Thank you.
Hi, Colin. Let me take your second question first. You've seen us issue debt this year. We have a lot of options available to us as we continue to fund this growth that we're seeing in AWS. So we'll continue to look at all the options and make the appropriate decision at the right time, but nothing to share today. And your first question, Colin, we see a very substantial opportunity both for our customers and for AWS in building some of these agentic applications. And some of this is born out of what customers tell us they wish they had and they want to be using. Some of it is born out of just needing to provide those capabilities to ourselves inside Amazon. And so, Kiro, which is our agentic coding service, is an example of that. But Amazon Quick's a really interesting example where we just had so many people inside the company who wanted really an intelligent AI assistant to help them work. At first it started off with, we're a very document-oriented culture. People wanted, when they got documents, not to have to read every document so carefully and to get a summary and then to be able to write their own analyses and responses to these things and to be able to do business intelligence through these agents. And that's really how Amazon Quick started, was to do research, to do business intelligence, to do summarization. And then we had so many people inside the company using it that they said, can't you actually find a way to make it much more productive and easier for us to manage our email, to manage our Slack communications, to manage our calendar, and to use all those things together? And that's really this next instantiation of Amazon Quick. And as I mentioned in my opening comments, it's pretty remarkable not only how fast it's taken off inside Amazon, but how many external enterprises have put it into production with a very large number of people at their companies. And we see that opportunity up and down, kind of the different needs of companies. I think that Amazon Connect, which is our call center service, which is used by all 5 major leading airline providers, as well as many of the leading banks and healthcare companies, continues to grow very quickly. AWS Transform, which makes it much easier to migrate software, is super useful for enterprises. And then the latest one we just launched with Continuum, it's really hard to have a conversation with a large company about AI right now where they don't actually ask you about security, with just all the noise and the hype about the security risks with the most current powerful models. And so Continuum really allows them to use those models productively, to find their own vulnerabilities in their code, to design the fixes, and to help them deploy them. And those are kind of the first set of them. They all have very high promise, but there are several others that we're working on, and we think that's going to be very helpful for customers and our business.
Thank you. The next question comes from the line of Jason Helfstein with Oppenheimer & Company. Please proceed with your question. Jason, your line is now live. Okay, the next question comes from the line of Ken Gawrelski with Wells Fargo. Please proceed with your question.
Thanks so much. Two, if I may. First, your RPO reported is 2.5 times that of the third quarter of 25 when you gave us the doubling of capacity comments for year-end 27. How does that RPO number and the massive expansion there impact your outlook for future capacity? I know that you talked about through year-end 27, but maybe at least qualitatively, if you could touch upon what the RPO means for 28 and beyond capacity. And the second one related is you raised your CapEx guidance this year for some supply chain inflation. Could you talk about how your pricing strategy at AWS incorporates future cost inflation? Your longer term contracts allow for stable return profiles despite cost inflation. Thank you.
Yeah, I'll start on the backlog number. Yeah, to your point, it's very substantially continuing to grow. I think it's a reflection, again, of customers being very, very enthusiastic about using AWS, both across core and for AI. We have taken in, we know about that backlog, obviously, so that's all taken into account in our CapEx projections. And, over time, I expect that we will continue to sign more deals with customers. And as I mentioned earlier, we're going to pursue the opportunity to continue being the significant market segment leader that we are. On the second question on the supply chain inflation, what I would say is that most of the deals that you sign, other than, there's a certain amount of your demand that is on demand, where there aren't contracts, but a large amount of it tends to be deals and agreements that you've signed. And the deals that you sign, those will be the prices and those will be the agreements that we have over the duration of that contract. And new agreements that you sign, you always take into account what your costs are in how you ultimately build a price that you agree to with your customers. And I think it's no secret right now to any company in the world that there are inflated prices right now on some of the components like memory and hard drives and SSDs.
Thank you. Our final question comes from the line of Eric Sheridan with Goldman Sachs. Please proceed with your question.
Thanks so much for taking the question. Maybe pivoting to the commerce business. When you're talking about scaling some of your initiatives around fast commerce and a wider array of supply of groceries and everyday essentials, can you talk a little bit about the signal you're getting from consumers in terms of either adoption rates of those services or what it's doing to overall spend trends, and whether there's any countries or geographies where you're seeing different outcomes as you launch and scale some of those services? Thanks so much.
Yeah, we are quite enthusiastic and excited about the pace with which we are growing the amount of everyday essentials as well as perishables in the business right now. And I think some of that has to do with the broader selection we have, and some of that has to do with just how fast our delivery has gotten over the last 2 to 3 years. And when you can deliver items to people, when you have that broad selection like we do at low prices, and you can deliver that selection to people as fast as we are right now, people consider you for a lot more of their total purchases and shopping visits. And we've talked for a while about grocery, and we have a very large business in that space. It's last year it was over $150 billion in gross merchandise sales, making us the second largest grocer in the U.S. And a lot of that are non-perishables. The middle aisles that you'd find in a grocery store where you have consumables and canned goods and beauty items and pharmaceutical items. A big chunk of it is our Whole Foods Market business, which is the leading organic grocer out there. And if you look at the growth in geographies that Whole Foods Markets are in, they're significantly outpacing the growth of comparable grocers, and the profit trajectory continues to trend the right way as well. And we found a new format there in Daily Shop in urban settings. It's off to an amazing start that we're expanding very rapidly. And then we always knew that if we wanted to serve the number of customers who want us to serve them and that we want to serve, we had to find a way to offer mass brands and perishables in a significant way. And we've tried lots of experiments over the last few years, as we've talked about on this call for a few years. But we have finally found something that is a real needle mover for us in offering perishables in our same-day facilities, that we're now able to offer same-day perishables in 2,300 cities around the U.S. If you look in those cities, 9 of the top 10 bestsellers in those geographies are perishables. You know, the number of monthly active perishable customers has increased 50% since the start of this year. And for same-day orders with perishables, on average, they average 3 times more units per order. And so we're just seeing very significant traction in our everyday essentials and in our grocery items. And we're not done experimenting, by the way, with other physical formats in the grocery side, but we've hit on something with same-day perishables in our same-day facilities that's changing the trajectory of our everyday essentials business.
Joining us on the call today and for your questions. A replay will be available on our investor relations website for at least 3 months. We appreciate your interest in Amazon and look forward to speaking with you again next quarter.
Okay, folks, that was Amazon. Apple is down after hours on some misses in China and services. Stock obviously took a big pump going into the print, but Amazon with the $220 billion increase on CapEx, $20 billion up from the previous guide for 2026, not even 2027. The stock not reacting negatively at all, actually up more than when it was before they announced it. Hit 260 at one point, up 9% after hours. And Jassy says he thinks AWS can get to $1 trillion of revenue per year. If AWS actually gets to $1 trillion of revenue per year, right now they have a $469 billion backlog as well. You're obviously going to need a lot of compute if you want to serve that much cloud, which is why Micron, SanDisk, Bloom Energy, all your semis are pumping after hours. Neil, your reaction to the call.
Can you imagine how big of a company Amazon could be if AWS alone is $1 trillion? Like AWS is at 39% margins. What's the multiple you slap on this? 10 times sales? More? That's a $10 trillion company just for AWS. It's insane. It's crazy. I'm sure Jose will dive into the details in a bit, but I also found that the free cash flow comments from the servers, the return on investment there, that it takes less than 3 years. Like the contracts break even in less than 3 years, which means they're going to generate free cash flow, a lot of free cash flow in years 3 all the way to year 6, which again is also very good to know for everybody else out there. Because now we can start to see, okay, maybe 2 years down the line, some of these neo clouds might also start making quite a lot of money and the story might make sense. Jose, I will leave the rest to you.
Yeah, I mean, crazy earnings tonight. I mean, one thing that I think Andy did was really give confidence about the investment, right? Just like Neil broke it down, right? They did share about the 3-year free cash flow positive on servers. I do think certain neocloud players have also said similar things, so it's good to kind of get that data point from other players as well, at least someone in the big name. The other thing is, right, the confidence with what Amit mentioned, $1 trillion, and Neil mentioned that too, about the $1 trillion. It gives confidence on that CapEx. It's like, this is a goal. Like no other player has given you a goal of what they expect to achieve with this investment. And they even mentioned that they're already seeing visibility for demand for capacity in 2028, right? They're like, we're pretty much what we're building in 2027 is sold. And the visibility for 2028 is crazy. And the final thing I would say is like, they started off, he started off the earnings pretty insane. He says, AWS, which is booming, and I will share the numbers, what we think is going on and why we are excited about the ROI equation even with heavy capex next few years. So I mean, semiconductor AI investors should be very, very excited after this. And yeah, I think the big thing here is they gave confidence, right? They gave confidence where the other players, they were, and also I feel like every other, Google did it too, but I feel like Meta and Microsoft were like a little hesitant. They're like, if we don't see a return, we can do this instead. We can do this instead. But Amazon didn't give you an option. They said the way they gave it, it was full confidence. This AI solution, these AI servers are going to make us money. We don't have a plan B because we don't think we need a plan B. And I wonder if that confidence is also kind of helping investors feel a little bit more comfortable with their capex.
I 100% agree with you, Jose. I think the reason the stock's actually up is because the confidence that Jassy was speaking, and Jassy's always been really good at kind of explaining his vision and saying it with some level of enthusiasm that makes you believe in what he's saying. But he kept mentioning 2028 demand is already getting booked, implying that, and you know, Cloud Code, agentic inference, all this stuff that was the reasoning behind it. But to your point, when he said we're increasing capex, we saw a little red candle. And then within seconds, when Jassy was talking about why we're so confident in the capex and the negative free cash flow, for now, he compared it to the original AWS business in 2006 when they started generating losses to be able to build out cloud computing. The stock went back up, right? It was almost like the market was like, all right, yeah, like go ahead, spend the money. And, you know, this entire year has been back and forth on like, should they spend? Should they not spend? Should they spend? Should they not spend? I feel like this was one of those calls that really solidified why they are spending. And it's kind of tough for the market to not take the semis up after hour, because obviously if they're spending, you need the semi stack. But also Jassy made you feel like there really is a reason to spend. Zuckerberg didn't make you feel like that yesterday, which is why the stock is down. Nonetheless, all of these guys will probably continue to spend, and all of them probably will get a meaningful ROI. And if Amazon's going to get 39% operating margins on 40% growth on AWS, then you know the stock's likely to go higher.
Especially since we are at the start of the build out, and they say it, right, the shell spend is something that they don't have to repeat every 5 years, right? It's something you do once, and then it's like a maybe not meaningful percent of your overall spend, but it's definitely close to 10%, for some maybe a little bit more, maybe a little bit less, and that's something you don't have to repeat every 5 years, which means that cost is going to come down in the future when you're going to see way more efficiencies, because I also believe that the cost of memory is going to come down. Everyone's going to be way more efficient. So naturally, all of these companies will just become more profitable while spend drag goes down. So, yeah, we're only going to go up.
And one more thing I thought that was good for just evidence is I feel like one of the big a big bearish case around here is that AI servers are lower margins than your traditional servers. And I think Neil kind of touched on this a little bit when he was just talking, but that the margins on AI servers are on par and better than expected compared to when they really started AWS with kind of those traditional. So that's giving you this clarity that AI servers isn't as weak as kind of some of the bears or some of the negative stories are out there telling you.
Yeah, I agree. This was the quarter that we needed on a good day. Like, I don't know if the stock's going to hold this tomorrow. It's a Friday. You have whatever macro stuff, but like if the stock were to go back down to 220, 235, now they've got these updated numbers. The fun thing about when a company executes and the stock goes down, you kind of feel excited to buy the dip. So this was a good quarter. I mean, I don't see the red flags in this, especially given operating margins are at 13.7%. I think they did the best job explaining why they're spending on CapEx. And, you know, we haven't even really gotten into the robotics revolution that Amazon should play a role in. They're already projected to be the first $1 trillion revenue company. Now Jassy's like AWS will be $1 trillion by itself. It's like, it feels like this was the best Max 7 earnings I think we've had so far. All right, folks. That is it for us. Thank you all for joining. We will be back next week, or I'll be back tomorrow. But the earnings will be back next week. I'm sure I'll be streaming with these guys next week. AMD, I believe Tuesday, will be a big one for everybody. Palantir on Monday, I'll be streaming that. We got
Grab.
SanDisk on Wednesday, Grab. We have Zeta. We have Celsius, D-Wave, Shopify, Uber, Disney, Spotify. A lot of companies that we'll be looking at next week. But most of the major earnings are out of the way. I think NVIDIA really should be closer to 215 right now after those Amazon earnings. So I'm excited for NVIDIA's numbers. But if the market's happy with the CapEx spend and NVIDIA gets to be proven right about the CapEx continuing to be spent, NVIDIA should be one of the big winners. And so below 200, hopefully we see that one catch a bid.
Part 2 is happening soon, like AMD and then all of the neo clouds. The Nebius CoreWeave, they're going to report. I don't know when Oracle is, but I think we have maybe a little bit of time on that.
Right. All right. Thank you, everybody. Appreciate you all. Thank you for spending the time with us. We will be back tomorrow and next week for earnings. Bye, everybody. Have a good one.
Bye-bye.